So the market's becoming volatile. The VIX is starting to rise. We decide we're going to take money off the table, whether it might be an individual stock position like Apple, or it might be, let's say, the SPY position, SPY, or another ETF, and we're going to replace it with a deep in the money call. We're going to do that because we're going to take a lot of risk off the table, and our slope is going to be is reducing as the market comes down, our beta. There's a small cost to that. That's what we talked about in a previous video. But let's take it to the next level. Now the market's starting to get real volatile. Volatility, because it has high serial correlation, which means what has happened will happen again. But serial correlation is sort of like an echo. If you believe that and the white papers support that, then what you can do is you can start converting your deep in the money call to our version of a call backspread. Now, a call backspread is a very heavy trade to hold and carry. The cost to carry that trade on a daily basis is much greater than the cost of holding a stock which doesn't have carry, or deep in the money call, which has a little bit of carry. A call backspread has a lot of carry, but when markets are whipping around, a call backspread dissolves at no loss. So if we see a drop in the market 75 basis points or greater, we're actually going to really outperform the stock and even the stock replacement. In fact, if the market's down, 1.5%, 1.75%, 2%, that call backspread dissolves at a credit. But if the market should run, the call backspread's got a lot of curvature. We call that gamma. So you actually do better on the upside. You'll do better on the downside. The only problem with the call backspread is market goes flat, you need to get out of the trade. So what I would recommend is, from a risk management point of view, as the volatility starts to rise, as risk starts to rise in the market, you could drop from stock to stock replacement to a call backspread. As the market starts to calm down, get out of the call backspread, go into stock replacement when everything is quiet and markets are not as volatile. So really a great way to manage risk, but you're not market timing, because what you're doing is you're keeping your exposure to the upside exactly the same. You're keeping your equivalent shared position exactly the same. Don't believe in market timing. That's what's nice about long optionality. As long as you're mindful of the cost in holding long optionality, it's the perfect investment, and uncertainty is abound. So here's where we can use optionality to really manage that risk. Thanks for listening.